So Wall Street expecting the Federal Reserve to cut interest rates next month. But some analysts don't agree. Where do you stand on this, Phil?
Well, I think that, modest cut, a quarter point, something like that, has been priced in for a long time. We've been expecting 2 cuts of that small size this year, and the September meeting's been circled on the calendar for a long time. So at this point, for them not to cut would be seen as tightening relative to market expectations, which I don't think is what they want to do. The sort of steady state the course move would be to give that quarter point cut. So that's what I think they should do, and what I think they will do.
Well, Mark, where do you see this?
Yeah, I agree with Phil, and of course, we look, as many traders do, at the CME FedWatch tool, which is actually a barometer, if you will, of what the expectation is of professional traders of what the Fed will do. It's predicting right now about an 85% chance that the Fed will give us that first 25 basis point cut. So I don't think there's really much news there. The news is going to be in and around the commentary from Chairman Powell on Friday from the Jackson Hole Jamboree, as I like to call it. Because if we remember, guys, last year, August 23rd at Jackson Hole is when he made that famously dovish pivot, actually coming out and telling Wall Street and investors it's time to make a change. So are we going to get that 25 basis point cut in September? Yes, but I want to hear what Jay Powell has to say about his plans for the rest of the year.
You know, Phil, so many Americans are struggling to get their first home, especially given, this high interest rate environment, which conflicts with President Trump's vision for America. So where do these high interest rates, where do you see them going? Because a quarter point is really not shaving off enough to make those mortgage payments affordable.
Well, the Fed really only controls the short-term rate. The federal funds rate is an overnight lending rate between banks. And, the idea that the president has that if the Fed cuts, that's going to flow right through to lower mortgage rates, I'm not so sure. Last year, we got 2 Fed cuts, and both times they cut, the 10-year Treasury went up and the mortgage rate went up. And if we really want to get the mortgage interest rate down, the most important thing to do is to cut federal spending and to have a real consequential move on federal spending so that the outlook changes, so that inflation expectations for the medium and long term are reduced. And so I see it more as a fiscal challenge to get the mortgage rates down than a monetary issue.
And Mark, your thoughts on that?
Yeah, I think Phil is largely correct. I would only point out some of the word we got this morning from S&P, talking about why they would expect to continue to maintain the government's AA bond rating. And part of the reason for that, and this comes to that fiscal policy that Phil was pointing out, is that there is an anticipation that tariff revenue, which exceeds $165 billion and counting when I last checked, is expected to offset some of that government spending, particularly some of what was set forth in the big, beautiful bill. So it remains to be seen. But yeah, listen, unlocking the completely frozen housing market, existing home turnover, sales of existing homes is at a historic low month after month after month. We've got to find a way to break that iceberg and bring the American dream back to the American consumer.
To that point, a new Reuters poll showing the majority of those asked predicting the Fed would lower its benchmark interest rate by a quarter point, as you both agreed, by September 17th, marking the first cut this year. However, again, Phil, I don't think that's enough. Why? Because the American people during the Biden administration, Biden-Harris administration, they dealt with a 9% inflation rate that lasted for years. So when people have been crushed for that long and they're still dealing with higher interest rates, not being fully into, let's say, markets, the housing market, and so many other things, they needed a reprieve.
Yeah, look, the consumer is still struggling. There's no question, and I think that's why economic sentiment has been a little bit weaker than the top line indicators would suggest that it should be. And we got a 3% GDP report, but people don't feel like a 3% economy, and I think that's because we just went through this huge bout of inflation. And even as we're now down in sort of the 2 to 3% range, remember that's cumulative on top of that 20% bulge that everyone experienced, and we really just passed the point in the last month or two where the average kind of median worker in real terms is back to an all-time high, which is to say we're finally out of the hole that we were in. But people don't just expect to be out of the hole. They expect their standard of living to increase year after year. And we're not really back to that yet. And so until they feel that way, we're not really going to have positive sentiment. And to the extent that rate cuts will kind of boost economic spirits and get more activity going in the near term, I think they're definitely a positive. The question, as I said, is just what does it do to that medium and long-term inflation expectation? What does it do to those long-term interest rates? And to me, you've got to have that ingredient of fiscal restraint, or else we're not going to get where we want to be.
Sure. And Mark, we got about 30 seconds with you. Your final thoughts?
Yeah, and listen, the blame here really lies with Biden and Jay Powell. This is part of the reason why President Trump is so vocal, so critical of the Fed chair. Don't forget, guys, this is the Fed chair that waited too long to start changing monetary policy and then embarked on the fastest rate or pace of rate hikes in U.S. fiscal history. That's what got us here, and it's hard to undo. It's not something you can undo overnight, but it's Jay Powell who's to blame.
Absolutely. Well, thank you, Phil Kerpen and Marc LoPresti, for breaking it all down for us.
Thanks, guys.